Hey guys, it's time we discussed what Wall Street might have just been getting up to over the last 24 hours and why it could affect all of us, whether we're traders or investors. More importantly, why are CTAs continuing to sell into a week that brings inflation and, of course, earnings season kickoff with the biggest banks? Speaking of banks, Wells Fargo is making a big call, 5,535, and more volatility set to come into the markets on the horizon. And we're seeing this across the VIX and many other pairs. But while Elon tries to save Tesla with robot taxis, there was a small candle that we need to talk about. It might not look like much, but there was actually quite a lot going on underneath the hood. So with the S&P 500 key levels coming up, what's going on with bonds, Tesla's trying to find its base, and of course the inflation trade we've been talking about for well over a month now continuing to go bonkers. Are there still great opportunities on the horizon? We're covering stocks, commodities, and cryptos to find out what's next. Well, welcome back everybody to The Daily Show. My name's Tom, and today we'll be going through from everything from macro to lead indicators and the hottest charts. If it's your first time here, remember to subscribe, smash that like button, and comment down below with your favorite stock that you are enjoying right now or sector. I think it might have changed over the last month, so let's see what everybody's liking. Now, what about the probability of a recession? We're coming into another earnings season, and the chance of a recession is dwindling by the day. There's no landing or basically soft landing now being the main two expectations. And Goldman Sachs is coming out and saying it's only 15% chance. Just a reminder to everybody out there, there's not very much chance of a recession happening until you ever see an inversion of yields. So has that happened yet? Absolutely not. We'll show you how to see it later on today's video. Let's talk about earnings season though, because everything has been growth driven and realistically large cap driven. The top 10 stocks have been performing, they've been bringing through the gains, and mid caps have just started to turn their head up, which is pretty normal in other rallies. Although small caps are really struggling in this higher for longer rate environment. So is that about to change? Well, let's talk about where the growth potential is this earnings season. The current PE ratio for the equal weight is only 17. The average since 2009 is 15.5. Meanwhile, the S&P 500 market cap is 21 versus 16.2. And that's because, of course, we're being led by AI stocks. And I tend to liken it more to this period of time over here than probably this period of time where equal weights did better after the tech bust. So what we could be going into is even higher valuations on certain stocks. And just remember, when you enter into bubble territory, which we're not at the moment, but if you do enter into one of those, then things can get wild, like 2021, and of course, like the tech boom. But will equal weight still be a great area in the markets? Well, I tend to think so because 2024 bottom-up consensus EPS revisions are starting to change. Take a look here at the expectations. In 2024, everything is above average, and earnings revisions are actually starting to improve across the board. And it's got Wall Street starting to get a little bit more excited about the mid caps in particular. In fact, by Q4 of this year, it's expected that stocks that aren't the Mag 7 will actually be outperforming the Mag 7. And this is the natural progression when you make a new all-time high on markets after seeing basically a bear bust, over 20% drop on the markets from high to low. Now, whenever that occurs, usually the biggest stocks go first, the large cap, the quality, then the mid caps, then the small caps start to come through. So take a look here and you'll notice that overall we had a massive sell-off across the Magnificent Seven. They've since performed incredibly well. And while we didn't see as much sell-off in the broad market, that's why it's not able to get back and do as well just yet. That is probably set to change, but just remember this quarter is going to be very important because all of the market's expectations are on the Mag 7. 37% EPS growth and -3 expectation on the other stocks. So if they start to do a little bit better, remember Wall Street doesn't have very good expectations for those stocks. Here's the bottom-up consensus. You'll notice it gets higher on the expectations as we get into the end of the year. And right now, this earnings season, I think, is going to be very topsy-turvy. If the big tech stocks don't do well, get ready for some volatile times. If they do well, well, we might just be holding prices or even see sell-offs due to the fact they've already been pricing in some amazing EPS growth. And take a look at what's going to happen. It's the same old, same old. Every single company is going to be mentioning AI as many times as possible. And look at the expectation of how many stocks overall are going to be doing it. Whether it's the Russell 3000 or the Europe Stoxx 600, over 30% of companies are going to be mentioning AI out of control from all of these major sectors. Interestingly, not too many in consumer staples, at least in the US, but there will be quite a lot in Europe, which are starting to maybe implement some technology or try to anyway to claim that stock price going up. This week kicks off the biggest earnings, of course, which is the start of the banks, and then we go into the big tech. Now, why I say it's pretty big is because JP Morgan will be in focus, along with how the sub-tier banks are going. Wells Fargo and Citi often have a little bit of problems. JP Morgan sometimes does very, very well. So if these ones start to show some weakness, the markets do react very quickly to all of this. And remember, we're kicking off also with Tesla and Netflix and all of those big tech stocks over the next couple of weeks. So subscribe to the channel as we'll be covering all of this. Expectations of implied movements are going to be higher as well. So we can see here that Wells Fargo is coming in with a plus or minus 6% move. Citi's going to be big, and JP Morgan as well is expected to be pretty volatile. So I think we've got to start here with the S&P 500. We'll go through some of the hottest sectors a little bit later on, but these charts really do matter. And on the surface, you might think, well, nothing much happened, Tom. Why are we even paying attention to the S&P 500 right now? Well, let's just stop there, because I can tell you that there were some large trades going through at these particular levels, and we'll show that a little later on along with the options markets. But do remember, as we said on the weekend video, the 5200 level was all important in this current negative gamma environment. If that price had been taken out, we're probably moving towards 5150 structure. Now, as it turns out, that's not what happened. We stayed in the very tight range, which is perfectly normal because it means they don't have to pay, they don't have to do any hedging, and maximum profit was made by the market itself. But what happens next could be quite important. Remember, we have a series of very interesting structure levels on the markets. We have a high, we have a low, we have a higher high here in markets, and then we ended up seeing lower lows over what has been a very strong trend. On the smallest time frames, such as 2 hours and below, the bears are actually potentially in control of this market right now. Now, if you look at a daily or a weekly, of course, the bulls are wiping the floor. There's no doubt. But when we look at the structure and we deep dive into it a little bit more, we've got a 61.8 fib pullback. We have a very heavily traded zone that goes right through this level along with 52.34. And we know that the bulls will be champing at the bit to be able to break through those zones to send us to all-time highs. By the way, if we do go to a new high level, there's a good chance that 5,400 would actually be the next level and not 5,300, because we got so close to it last time and then sold that level or range. So what's really going on here? Well, let's have a look at the overall action from the options perspective. And I think this is probably one of the most important things that we need to track right now due to the fact that we're moving from positive to negative gamma environments. So let's understand where we moved to last session. 5,200 was the put wall. If we'd gone underneath that, 5,150 would have been the next most important zone. Because we didn't, and now we meet the 9th of April, we know that the new put wall is at 5,175. So the chance of the market moving down to 5,175 is, fairly high. Does that mean it's super negative? Not yet. If it does manage to get through 5,175, that's when volatility may spike. Hedging down to 5,150 would make sense for the next session because we know that's where the most amount of puts are. And we're actually moving from potentially a negative gamma environment into a positive gamma environment very quickly if we manage to hold up through the next session. So while the bears control it right now, they kind of need to pull that vol out over the next 24 hours. If they don't, you can see how many calls are here. And of course, if we go back above 52.50, that's going to need to be most likely hedged off. So again, that's going to create that squeeze rally that we've become so accustomed to throughout 2024. When it comes to OPEX this month, you'll notice where the big calls are, where the puts are, and 5150 to 5100 still remains that major big technical break that will really bring the swing traders in the bears. So let's look at the horizon. What's going on with CTAs? Now, we know these tend to be systematic funds, and they're following something going on right now because they're selling across the board at the biggest rate that they've done since October. Now, this is not just in the S&P 500. It's also in the NASDAQ. We already alerted you guys on the weekend. We all talked about this together, that we made a new low. So because we made a new low, we know we need to be focused in on these markets in particular. And we need to be looking at where the next opportunities are arising, and more importantly, those dark pool transactions, which we'll get into in just a few moments. Let's have a look here at what also has been happening on the charts. One of the big stories has been the percentage of stocks from the S&P 500 that have been above their overall moving averages. Now, this is the 40-week average, and you'll notice that changed quite a lot over the last week. Now, with price action kind of hovering like this, and we're making new lows here on the percentage of stocks above the 40-week average, it suggests that there's a little bit of inherent weakness in the markets. If we actually have a look here at this S&P 1500, new low breadths last week, coming on Thursday, actually showed that there were sell-offs across consumer cyclicals, healthcare, real estate, and technology funds. So semiconductors in particular have been actually copping it a little bit, which is perfectly normal for this time of year. But again, it's starting to show that maybe we're in here for a little bit of consolidation. Now let's go through where the good stories are. And of course, it's been commodities, commodities, commodities. You can see here that really anything from energy to gold, yeah, banks have been going up too, but metals, they've all been flying. And the opportunity on those is still quite large. And we'll go through that in just a moment. But I did want to talk about the S&P 500 losing its 2% streak. So basically, we hadn't seen a 2% daily change down for a long time. And it was over a year. It was a very long time since we saw a big sell-off like we did last week. One of the weirdest things we've seen in a while. Now, is it really bad for markets? Well, you can see here the percentages over the next 6 months are still pretty damn positive. We didn't really have too many major drawdowns during that period. So if you're in it for the long haul, I don't think there's too much to be worried about in this market right now, and we'll show you that in some other charts in just a few moments. Let's also look about risk-adjusted returns. Now, this is super important when you're an investor in markets and you've got large amounts of money. You don't want to be putting your money all at risk in things that can be kind of wild. Now, actually, Bitcoin's return to its risk has been really good this year, but energy has been the best. So there's always another area to look at in markets, and I think we're being pretty clear on that. Also, if we have a look at the New York Stock Exchange, you can see here the oil index versus moving averages is just popping off. It is green across the board, and it suggests there is still further action to come in the oil markets and in the oil stocks. When we also think about those 52-week highs into a sell-off like we saw last week, we also get these kind of reads that could say, well, we're in a topping area for now, still in a bull trend, because you'll notice in every case here, the markets ended up making new all-time highs. But there's a decent chance of consolidation. When you have a look at these arrows and you pause it here on the screen, you'll notice there's actually quite a lot of cases where we end up getting consolidation above that. Short interest has been jumping around the markets. A lot of people have been talking about this. I don't think it's too big a deal. 1.8%, S&P 500 median, of course, is still quite low by historical standards, but that is one of the big stories. Another thing we've been talking about is whether we're getting still in cheap for Chinese stocks. Now, here's a big storyline. It says Wall Street bankers face bonus and job cuts. Well, what happened after that? The markets actually rallied up. Well, as it turns out, we've just started to see the exact same stories in China. China stockbrokers suffer pay cuts and as market declines. Well, is this another story in what is currently looking like a base pattern on the price action storylines? Well, we'll be looking at that, of course, later as well. Let's go through S&P 500 election years. Seasonal patterns suggest that we should be going sideways to even down a little bit here. That's pretty normal by a presidential cycle. And of course, we are expecting that because we know we're tracking right now two of the major years, 12 and 1976. In both cases, we had stellar returns at the start, took a bit of a rest, stellar returns again. So things are pretty bright on the markets, but again, there is a chance of some pullbacks. Here is a case in point. Semiconductors during the month of April. Did you know that over the last 10 years, they've only been up 30% of the time, and they're living up to those expectations, being down so far in the month. Also, if we have a look here at May, 90% of the time, they're up. So could it be a good point to buy semiconductors soon? Well, based on the stats, it may be. Are we in a secular bull run? It certainly does suggest so. We could be around 2/3 to even 3/4 the way through a bull run. And if we overlay it with some of the previous times, again, it is due for that kind of sidewaysing action, which tends to be at around this period in time. So what about the US economics for the week? Well, we know that CPI is coming. Goldman Sachs here think that CPI is going to be forecasted to rise around 0.29%, and that is going to reflect higher energy costs, I think for sure, and food is also going to be in the forecast. Now, whether this is going to be super negative to the market or positive, I think that we're going to leave that up to how the market ends up reacting. And as we said, patience, react, don't predict. Often what's going to happen is you're going to get a great opportunity after the news comes out, not before it. Now, which is the big thing that everyone's talking? It's got to be oil. Oil has now become the focus of everybody out there. And all we've really been seeing is people starting to get the expectation of over $100 barrels. Now, I do think we're coming up to a big technical level, which we'll cover in a second, but we do know that really the reinflation trade has now become the talk of the town. Whether it's gold, whether it's oil, anything else, people have just been discussing it out of control. Sector compositions at the moment, you can see here that small caps, mid caps, and large caps, where they all come from. And you might notice as well that energy is actually quite underrepresented from a large cap standpoint. Materials and energy, only 2 and 4% of the markets. It's like they purposely don't want you to own any materials and energy over the next couple of years because they make up such a small part of the S&P 500. There's a real chance that they start to actually outperform the markets and have to get weighted up over time, meaning that the funds will actually have to buy more of them. Fed fund futures are now showing a 48% chance of a June rate cut. That's down from 70% last week. And these are the most important bits of information for the US coming out over the month of April. So where have the biggest trades been over the last 24 hours? Well, one that came as a bit of a surprise was certainly the ProShares Ultra Pro S&P 500. Now, if you're not sure what that is, it's a 3x SPY leveraged fund. And we just saw a huge trade on the Monday transaction. And it brings us into the story of whether we're continuing to see dumping by the largest funds around the world. One of the biggest transactions just a little while ago, another massive one, a huge one over here. And then right when we hit the 61.8 fib, we also see a huge trade. And this led through to also one of the other large funds out there, which is the RSP. Now, in similar situations, you can see how important these dark pool prints have been. We've seen buys, we've seen sells, and of course, we've seen other huge transactions. More notably, the back end of 2023 ended up leading into a bit of a pullback in time for the equal weight. Now we've just seen the largest transaction over the last 2 years. So does this mean that Wall Street is selling, leaving us holding the bags? Well, when we can't reclaim the level that's already had so many trades on it, you know that means something serious could be afoot. And right now, dark pool activity is leaning towards the bearish side. There's no doubt. It's the first time we've seen this pretty much all year. So let's take a look at the state of the markets over the last 24 hours. A bit of a mismatch. Utilities, one of our favorites recently, was doing well. And BlackRock coming in and buying a little bit of the REITs. Have they actually bottomed off? That's a story that I think will come in another one of our videos. And as you noticed, 5 days average has really just been inflation trades. Everything we've liked, from gold to energy to metals to utilities. It certainly hasn't been the best for semiconductors, and that may continue as we start to see weakness across the board. Let's move over here to VIX. Now, the VIX spiked, it went above 16, and then it's dropped back down. This could still spike right back up. CPI and, of course, earnings results, plus other central banks around the world are announcing a whole bunch of things. What about the bonds market from the index options? Well, we didn't see that spike to a new high, which, of course, means it could be still the calm before the storm, but we're looking towards, if this spikes, things could get, again, a little bit more negative on markets in the short term, not the long term as far as we're concerned. Central bank liquidity from both the Fed and other central banks around the world remained pretty tight. And as we've been mentioning, it's really this story of the US 2-year and 10 years all breaking out across the board that has people talking about the reinflation trade. 4.4% was broken through last week. And it suggests that if this keeps going higher, it could be a bit of a problem for the markets. Just remember, if you're ever wondering when do you need to be actually concerned about markets, you want to type in US 2-year versus 10Y and 3 month versus 10Y. And when this uninverts, that is, goes underneath the 1% figure, that's when you really need to start talking about it. Usually it's about 6 to 12 months after that you start to get very, very concerned. High yield junk bonds, they've been sitting around 76 to 77. As we know, the option puts that are everywhere right now sit on both of those strikes. If the market closes below, a lot of those will need to be starting to get hedged off, and it could create a flash sell throughout a very coiled markets. The bonds markets have been very, very flat, very safe for a little while here, and they haven't really been doing anything. But the next big move out of that coil is going to be important. What about home builders? No real movement here over the last 24 hours, so nothing much we can look at. And dollar remains still very stagnant, sitting right at that 104 level. It reminds me of that meme, come on, do something. This particular one is doing absolutely nothing, and it's showing up in the charts with long leg dojis. and realistically what we would call equilibrium in markets at this stage, waiting for the next big move. What has been moving nicely has been the copper markets. Inflation trades, copper in general, really breaking out. The inverted head and shoulders we talked about a little while ago, really starting to play out, almost there at 4.4. And if we do get to 4.4, could we be going to those new all-time highs for copper? Well, that would be, of course, the storyline there. So things looking improved at that point. What about gold? Has it run out of steam yet? Well, it's still up and it's still making a series of higher highs and higher lows. So gold could be continuing to go for a little bit longer yet. I've talked about how I think 3,000 is possible over the next 12 to 18 months, and we've said that for quite some time. But we are starting to get into that extended territory. So by some technicals, you would say you need to be more concerned about buying gold here, and there's more of a chance of a pullback. But as we make higher highs and higher lows, just like the stock market at the moment, it's been almost all green, all good, and you've just got to kind of follow that trend. The same thing has happened with silver. Silver actually hit the target. Congratulations to anyone that got on this squeeze over the last week. What a phenomenal trade. Actually hit my top end target here, as you can see, over the $28 and kind of 20 cents area. And this is a fantastic zone for silver to be in. And it makes you wonder, well, is silver still cheap? Well, like anything, you should be doing ratio style concepts. And you'll notice here that silver has been playing catch up to gold in recent times. It's actually been improving, but it's still not at that 0.013 ratio to gold, which suggests that in pricing of 2022, 23, 24, and even other periods, that silver still has some room in it. So even though it's hit our target profit, it's still relatively cheap when you compare it to gold prices right now. US oil, very strong on the charts, ended up bouncing off one of those key levels we discussed, and it's trying to make a new high. So as long as oil holds above this 84.50 area, it's all kind of green at this stage for the energy sector. XLE starting to take a little bit of a rest just before 100. This is the energy stocks. And what you should really be doing for energy stocks, if you're wondering whether they're expensive or cheap, is again looking at them in comparison to the S&P 500. And you'll notice that they're nowhere near where they were back in 2008, 2011. They're still quite cheap across the board. They've hit that level of 0.1747. You can see it's ratioed up from that point. If you're looking at this of whether it's, getting near a price that's going to be a little bit restrictive, you could argue that there's a resistance coming up on the charts. But I think that the 0.3 ratio from energy to the SPY combo is a real deal in the future. So, energy's still got quite a lot to run on it, especially if we continue to see reinflation and a huge demand on energy due to the AI revolution, green revolution, all of these types of things. Small caps to mid caps. Well, how are the mid caps going? They're starting to weaken a little bit in more recent terms. They've been a very strong trend. For now, they're still technically up across the board, but you'll notice that mid and small caps are both being hit a little bit more than even the large caps in the current market environment. Are they going to offer superior returns in the future? There's a good chance that they will, and mid caps in particular could be a focus if we do end up getting a pullback. But one of the main levels I'd be looking for on something like this fund would be at least 84 on the charts. Semiconductors have been weakening, pullback in time. As we first reported when we saw that huge Nvidia sell-off, this is pretty much what we expected. SMCI probably got the most people holding bags at 1,200. I remember some of the comments, and there were a lot of people very, very bullish on the stock here. Just remember, it's when everyone gets super euphoric, especially after such a candle like this, there's a good chance you're going into a sidewaysing market or even a pullback. So something that's occurring here in SMCI, maybe it's getting back into around your price range. Maybe it'll get back down to 700, who knows? But it is starting to weaken. Nvidia, everyone's favorite stock, also starting to weaken. One of the levels that I think everyone's going to be wanting to look at is 850. Now, if the market does break underneath this, and the stock market still hasn't broken underneath some of the key levels, I think it suggests that Nvidia could be coming to a very fantastic level between 780 and 800. Now, a lot of you would like that quite a lot. And of course, even more, I'm sure you'd like a 673, which is a huge gap fill zone. This actually turns out to be a 61.8 of the last pull as well. So I wouldn't discount these being potential possibilities during the year. And for now, all buyers will be looking at the 850 to 860 level and saying, you know what, that's where I want to be buying it on the smaller timeframes. Nothing has changed there. Let's move over to Tesla. So Elon said that they're going to get an autopilot taxi, and that's going to be announced, I believe, in August. and that helped to propel the stock up. But really, I think it's more of an excuse. The market itself is fairly sold on Tesla. We saw, of course, that watch reaction here level. If you managed to buy that, congrats to you. Good to see the market hold above that last high, and it suggests that maybe we're in further accumulation potentially for Tesla. Big volumes off those two zones have, probably someone's got loose lips on it, or at least there was some speculation. But for swing traders, you're not really going to like Tesla until it gets above 182 on the charts. Let's move over to Tencent and China. Now, Tencent has already broken out to the upside. This is like kind of one of the most popular stocks. So really, if it's moving, then you've got to be paying some attention. And you can see here that HSI in general has been improving. 17,000, we're looking for a closure above that. That's the Hang Seng to really get further slingshotting momentum from the Chinese market. For now, it's still a series of higher highs and higher lows. And I particularly like that entry for some people that are doing day trades or multi-month trades, because it does look like it's trying to break this very long-lasting downward trend line. Things are certainly starting to improve. You'll notice the inverse head and shoulders capability, left shoulder, head, right shoulder. So many things going on in that market. When we go over to the US 2K, it's still holding the ascending channel. For now, I don't think the bulls are really back in control of this market until 2110 is closed above, and bears will just be looking for a new low. New low brings new pain, I think, on this market. So again, something that everyone will be focused on. Set the alerts and check it out. What about the Qs? Are they showing strength? It's very similar to what we've already seen on the other markets, which is a potential of distribution or accumulation. The trend is still up. The pullback in time is certainly occurring. And of course, we have a potential BC, UT, UTAD strategy here from a Wyckoff distribution. So just remember to keep your levels underneath the NASDAQ on the most important watch. We've been talking about the same level for a long time, and I'll put it here on the futures. And of course, it is this one here, 17,780. A new low below that will certainly not be great for the markets. For now, the trend is still bullish, although you will notice that all these wicks are pointing towards the downside. So if the market does squeeze, you can really see how many people would be caught off guard, because 18.4 has clearly been sold quite a few times, and there'll be a lot of sellers there. So if we get above, get ready for some further squeeze action. For now, I'd say the bears are in control of the smaller timeframes. Now to Bitcoin. This is a confusing chart. Is it just further consolidation, or is it actually a breakout to a new all-time high? It looks pretty good on the surface, I guess. From the perspective of what I would do, probably nothing. At this stage, if I was hodling, well, I'd still probably be hodling, because I don't think you've got too much to worry about. Are we at 100 or 150K on Bitcoin? Not quite yet. Did I think there would be a little bit more selling action around here? Yeah, I probably did on the small timeframes. I thought that was possible. There was great buying here. There was decent selling here. And the buyers, due to the overwhelming trend being up, ended up holding through. Really, buyers don't need to be too terrified until this market gets back down to below 63, which I think will push that narrative of going towards 51. So for now, it's just basically sideways on the Bitcoin market with not too much information of either direction being stronger. For the week ahead, remember Wednesday is the big day of CPI, so that's going to be at 8:30 a.m. New York time. Then, of course, we've got a whole bunch of central bank information around the world, and then we kick Friday off with the big financials. So make sure to be ready for this earnings season, and that's just a reminder, there's going to be a lot of opportunity. So subscribe to the channel, smash that bell if you enjoyed today's video, and of course, follow us on the socials, links in the description down below. Thanks so much, guys. We'll catch you in the next one. Bye for now.